Welcome everybody. My name is Jessica Bingham, Sustainability and Accounting Manager at A4S, and welcome and thank you for joining our webinar today. Just a bit of housekeeping. Please note we're recording the webinar for others and it will be made available on the A4S YouTube channel afterwards. So these monthly webinars are part of their A4S Academy, a program designed to sort of empower and equip senior finance professionals with the skills needed for their businesses to succeed in the face of environmental and social risks and opportunities. So these webinars are open to Academy and non-Academy participants, and everybody is welcome. So on the agenda for today, we have a panel discussion with external speakers from JAPFA and ABN AMRO, a Q&A with the audience, and then an intro to the A4S content, and then I'll wrap it up at the end. You can also ask questions freely in the chat function throughout the webinar. So the learning objectives of this webinar: after completing today's course, you will be able to describe how ESG risks are considered in debt finance decisions, to identify the benefits of implementing a sustainable finance framework, and to translate the experience and learnings of others on sustainable financing to your own work. Companies with the ability to transform capital from the financial markets into projects with tangible impact on the ground are an essential part of the solution to delivering a sustainable economy. So many of you on the webinar today are from finance and treasury teams, as well as other departments, and the growth in sustainable finance in recent years presents some interesting opportunities for you. So our speakers today can help you to reflect on your own companies and what opportunities you may be able to do something similar. So I would like to now introduce you to our moderator for today's panel discussion, Caroline Stockmann, Chief Executive, the Association of Corporate Treasurers, Deputy Chair, International Group of Treasury Associations, and Board Member, European Association of Corporate Treasurers. So thank you very much for joining us today, Caroline, and I will pass over to you.
Thanks very much, Jessica. I was asked to start just by telling you briefly about my roles. It's probably self-evident what a chief executive is. So I'm chief executive of the Association of Corporate Treasurers. Just to clarify that we're a global body. We work in around 90 countries. We deliver qualifications for treasurers from fundamentals right up to master's level. And there are exemptions for people who previously studied as accountants, but it's getting really into the specialism of treasury and all that it entails. And we're delighted that a very large percentage of our members say if they were doing it all again, they would be a treasurer, because it's quite an exciting role, really very externally focused, forward looking. And we've seen in recent times it's really critical to businesses. And as said, my role on EACT, the European Association, that's where all the associations across Europe come together. And ICTA, that's where the international associations, of which we have about 30, all come together, and we exchange notes and collaborate with each other, as is right, of course. Now, by way of introduction to today's session, I'd like to touch on the current landscape for sustainable finance and very briefly highlight that there's quite a spectrum in terms of borrowing, from use of proceeds, so for example a green bond linked to achieving a specific environmental project, through sustainability linked debt, etc., through to the incorporation of ESG factors into financial credit ratings. And the role of credit rating agencies is becoming more and more important. We're finding, particularly in our world, in the treasury world, and it's relevant for second party opinions, or SPOs, verification that the sustainability targets have been actually met. The whole area is subject to increasing regulation, reporting and rigor, and that can pose challenges for businesses. The good news, of course, is that businesses are taking the topic, if we can call it that, more and more seriously, which has to be good for society ultimately. And we've been seeing in our annual Business of Treasury research that people are engaging more and more, and we've been encouraging them over the last years. And fascinating to see through COVID how there was a real pickup, rather than people pushing it aside as a nice to have. People really engaged more and more with sustainability, with the support of A4S and other organisations. So that's really great to know. Sustainability is fundamental to the role of the finance team, as we know. You know, they are the ones who will be reporting on it. They'll be the ones who are driving some of the issuances, etc. And therefore, they need to be aware of the changing landscape and changing requirements. So without further ado, I'll introduce my panelists. On the panel today, we have Kevin Montero, Chief Financial Officer, JAPFA, who will tell us about their sustainability-linked bond, the first US dollar-denominated sustainability-linked bond issuance from Southeast Asia, as well, and he will also outline the sustainability performance targets under the bond and the thought process behind them. Japfa is a leading Pan-Asian industrial agri-food company dedicated to feeding emerging Asia with essential proteins. Headquartered in Singapore, they employ over 40,000 people across an integrated network of industrial farms. We have Joop Hessels here, Head of Sustainable Markets at ABN AMRO, who will talk to us about the trends he's seeing in sustainable finance, focusing particularly on the bonds market, as well as the developing regulation that financial professionals and auditors need to be aware of. ABN AMRO is a bank committed to playing a serious role in society. Their areas of focus are inclusion, sustainability, social entrepreneurship, innovation, daily banking, and more. So welcome to my panelists. And I wonder if I could just start by asking Kevin very briefly, why sustainability? Why is it important?
Okay, I think it goes back to when we started this sustainability journey. We actually went to our management to get buy-in and to encourage people to take sustainability seriously with the intention to embed it in our day-to-day operating processes. Right? And actually, while sustainability can imply additional costs, there's very little quantifiable benefit from embracing sustainability. And I think the bond was important because it enabled us to show that you can actually get some tangible short-term benefits on top of the longer-term benefits of building a sustainable business into the future. So I think in that respect, the sustainability-linked bond that we issued was a benefit to the whole sustainability push and to get top management embracing sustainability in our organization.
Absolutely, because I was a bit worried when you started out by saying there were no benefits, because I do believe personally strongly that there are many, many benefits. So I'd like to clarify that point, Kevin. Over to Joop now. Why are you passionate about sustainability?
I've started a couple of years back in 2013. I saw the first green bond issued by a corporate and a financial institution. And at that time I was triggered because I wasn't focused on sustainability at that time, but I thought, hey, this could be interesting for my clients. And then when I started talking about it, a lot of people say, it sounds very interesting, but we don't really know how it works, how we should do it. So they asked me, could you look into it? So I more or less rolled into it from a business perspective, but I was also surprised actually what I learned from sustainability and all the issues which were there. And I thought, well, maybe it's important that it's more widely spread, but it's also nice to link it specifically to your own business. Because when I started discussing it and we had internal discussions about sustainability, it was a bit far away maybe. So it was limited, like we should maybe travel less, print less, but that was about it. And now suddenly with sustainable finance, we could link it to our daily business, which was debt origination. And also our funding team had the same thing. They could link it to their business with making their part of the business greener. So that was, I think, the big change where people said, hey, this is really something which we can do in our actual day-to-day business beyond the regular stuff. So I think that was a nice trigger to get moving.
Absolutely, thanks for that. And it's fascinating. When I joined the ACT just over 5 years ago, there's really very little awareness, very little going on in the Treasury community, and we really pushed to raise awareness because we felt it was important. Already then, I knew A4S as a CFO previously. I had been working with them, and just it seemed like the right thing to do. But fascinating, at that time, I think people would have generally said, the shareholder is all important. And I think just in 2019, really, there became this big debate about, is the shareholder most important or the stakeholder most important? And then when we look at all the different stakeholders we have in business, we can see that many of them are concerned about sustainability. And therefore, we need to take that into account, because at the end of the day, the shareholder isn't going to benefit if the stakeholders aren't on board, if your employees aren't on board, if your supply chain isn't on board, and if the wider society around you, is not on board. So it's really an amazing dynamic, and how it's changed over those few years. But now to my first question, really, for you, Joop. ABN AMRO regularly publishes articles on sustainability, so you know a lot about what's going on out there. What are the trends that you're seeing in the sustainable debt market, including in terms of regulation, and what are the implications for issuers or potential issuers?
Okay, well, I'll do the regulation part last, because otherwise people get bored too quickly. No, I think the biggest trend we see is, first of all, investor appetite. I think it's a trend as from the beginning onward. It was also the reason I think the first green transactions came into the market in the first place. There was clear demand at that time, and the World Bank said, okay, together with EIB, let's do a green transaction. And yeah, when over time more investors wanted to increase their climate related investments, so that was a big trend. First of all, we saw dedicated funds, and now we see that it's more widely distributed, and also ESG is more part of their overall strategy, even if it's not a dedicated green bond fund or a green sustainability fund. It will be an important part. So you will get questions on it in any case, even if you do a regular bond. The other trend is that we've seen more and more products where the ESG element is in scope. So at least as far as I can see, it started with the bond side. Very rapidly also the loan market looked into this, and very recently we've seen also activities on the equity market. Last year we did the first green IPO, which was labeled. We've seen green derivatives starting. So there's a lot of activity on that side. See commercial paper as well. And another trend I think is what we see is a move, not away from climate and environment, but also it's expanded. So people think it's ESG, but there's more than only environmental. It's also the social element is important. So that is something which we have seen. Some issues who started with green also expanded in looking, well, what are the social elements we are actually focusing on? And if you have a mix, we call it sustainability. So that's a bit the three flavors. And last but certainly not least, from the loan market, a new type of product developed, and that's a sustainability linked market, which is not so much asset focused, but more on a certain specific target. And I think that market is rapidly growing, and of course that's also part of the discussion today, I believe. So I think that's another big trend, and indeed, last but not least, regulation. The market, at least on the bond market where I'm from, started actually as a market-driven initiative. There was investor demand. Some banks said, okay, well let's try to get those two together. We have an issue, we have an investor. But of course, over time, we saw more development bank type of clients starting to issue green bonds. And at the moment when also corporates and financial institutions started to go to the market, there was also the same questions popped up, and a group of parties came together and said, let's try to make it transparent so that we don't have to ask the same report to the same questions time and time again. And come up with some principles, and that was the green bond principles. It was a market-driven initiative. So also in that situation, it was a bit odd if you would also define your own rules, what is green and what is not green. So that was left to the market and to investors, and it also, I think, helped with growing the market quite rapidly. And of course, more recently, we've seen much more focus on regulation. Initially, it was more on a voluntary basis via the Climate Bond Initiative, who set some standards. And recently, we've seen also regulators for example, the EU in Europe, who set the EU taxonomy, which is a definition of what is supposed to be sustainable green finance. And in the future, they will also expand that to the social category. So it becomes less, or it becomes more formal as a definition. Doesn't always make it easier, but that's maybe something we'll touch base on later. But yeah, that's, I think, an overview of the trends I see so far.
Thanks very much, Joe. We do hope that all these different areas of regulation will coordinate with each other. I know, speaking with our US treasurers from the NACT that I'm president of, the SEC is getting active, but it tends to run at a different pace from others, and with the kind of legislative discussions that will be held in the US. And yeah, we just hope that everyone across the world coordinates, because it's going to be very difficult for certain multinationals if they have to conform to different kinds of standards. It's a bit like KYC. Those challenges may be ahead. But what's also great, as you highlighted, is the way that if we talk about ESG as a whole, and sometimes I think it's three different things lumped together, but they are connected, and seeing how that's pervading everything now. Our recent Deals of the Year awards, we have an ESG category, but we're considering stopping that category next year, because nearly every single of the 100 nominations we got had ESG elements in them. So really getting, it's getting to be the norm now, isn't it? And if you're not there, then you're not in the norm, and then suffer potentially the consequences. Let's move over to Kevin now. Really exciting, a first in Southeast Asia. Why was it important for JATFA to launch sustainability-linked financing, particularly?
Yeah, I think it was an opportunity basically to use some of what we've started as an initiative. So really, I'll go by background. In 2021, we issued an SLP, and we had sustainability performance targets, or SPTs, linked to wastewater treatment, recycling, and ultimately to improve water circularity and reduce water withdrawal from the system, right? So perhaps I can say why were we able to be the first was because we had prepared ourselves. So we actually had initiated a life cycle assessment of our poultry operations in Indonesia. It was a 2-year process. And as part of that process also, we actually talked to management and got management support of embedding sustainability, as I said earlier. And part of the reasons for actually embedding sustainability was because in our vision, we actually had identified our stakeholders, which as you mentioned earlier, Caroline, which covered a whole bunch of stakeholders just outside the shareholders. And in that respect, I think we were very proud to be launching the first sustainability-linked financing for the company.
And were the barriers that you had to overcome? Could you describe a little bit of the process, the hows and whys, and also the barriers that you may have faced along the way, and how you overcame them?
Okay, so the barriers were actually quite huge. I think perhaps what I can say is you need to get management buy-in. So even though you might have sustainability in the DNA of the company, you need to actually get management buy-in as you go along the process of doing this bond, right? So that management buy-in process is tough. And you need to actually go through that through not only the top management, but operational management, and then the finance people. As we all know, the CFOs and the finance people basically drive sustainability. So the main barrier is most people see sustainability as a cost. And the benefits, while we all know the nebulous benefits, perhaps that wasn't clear, the broad benefits of building a sustainable organization in the long run, it's the quantifiable today benefits that are very hard to give. And when we actually developed the bond, we had SPTs, or sustainability performance targets, that were based on building a water recycling plant. Now, a water recycling plant is something outside the normal business of JATFA. And what we had as one of the barriers was operational management would say that, we produce chickens, by the way. So operational management would say it'll make each chicken a little bit more expensive or higher cost compared to my competitors. So why should I support this bond? And does it mean that the bond is going to be cheaper? And actually, when you launch a bond, it all depends on the day of the book building, right? And the final process in establishing what the coupon is going to be. So you aren't able to answer that question clearly. All you can say is, yes, I think we're going to generate more demand, and that should make the coupon cheaper. And they say, okay, but I've also got to explain to you that there's a penalty if we don't meet the SPTs, and that's a 25% basis point extra cost. And everybody goes, why on earth would we want to issue this SLB? And I think that's a real barrier, actually, to the whole process. And the way we got around the barrier was 2 years before that, or 3 years before that bond, we had already conducted management buy-ins at top management, operational management. So when the day came, when the crunch day came in actually pricing the bond, I think we had people supporting that process and pushing it through. And for me, that's an important stage or part of the process, actually, as you move forward in thinking about a SLB or any sustainability linked project.
Thanks very much, Kevin. And we'll come back to talk a little bit more about finance's role, I hope, before we finish this session. But just want to remind the audience, we're putting questions into the chat function. So if you think of questions as we're going, please pop them in there and I'll deal with them either as we're going, if they fit in with the flow, or we've dedicated some time after my questions for your Q&A. So do put those into the chat. Now, just I'm going to stay with Kevin for a moment or two, because from my world, a key challenge for a treasurer, say, issuing a 10-year sustainability linked bond is about aligning the targets and performance metrics over 10 years with the business's ESG metrics, which may change after a few years. So we have a lot of discussion around that. So what if today's green project becomes viewed by investors as somewhat brown, as we often call it, after 5 years of evolving technology and standards in this area? People can very easily be accused of greenwashing. So just wondered, Kevin, before I turn to you also for your opinion, Kevin, what do you think of that? Was that a challenge that you considered? Do you think there is a risk when you have these targets, these linked targets, that over time they become less relevant? And how do you deal with that? It's quite a tricky problem.
Yeah, I actually think it's what's important to the business today, right? And you can only launch on that. But perhaps I can stress for us to be the first, and we were the first actually sustainability linked bond in the agri-food space in the world, on top of being the first in Southeast Asia for US dollars. And the reason we were able to do that was because we had prepared ourselves. So we conducted an environmental life cycle assessment of our poultry products in Indonesia, covering the whole vertical chain from feed, breeding, commercial farming, downstream, right? And we use external consultants. We started the process in 2019, where when things were not required, but we did it just so that we could understand our life cycle and understand our business as well in terms of the environmental impact. And the process took 2 years to complete, but it helped us also quantify the impacts of our products, of our operations, and basically the results provide a science-based approach to decision-making on environmental issues, right? So armed with that, that's why we could be the first, because we were ready with data. We understood what were the key environmental hotspots in our product life cycle, so that we could address those hotspots, being water and wastewater management, and do something beyond compliance. And that gave us, I guess, credibility, so that when we had the second party opinion by Vigeo, which is now Moody's, we had a robust rating from Vigeo, and actually that supported the bond issuance as well. So what I can say is you really need to prepare yourselves if you actually want to be serious about issuing any sustainability linked financing. And that, I think, also protects you from the greenwashing, because if things change within our product life cycle, we will know about it, because we continue to measure all environmental aspects following that LCA process. And that measurement continues until today, because we are obviously trying to track to see whether we are making those improvements, and we report on that. But it allows you also to maybe shift your attention to something that's perhaps more critical in 5 years' time.
Yeah. In a way, you would also hope that these changes come, right? So I think that's the whole purpose of the market, is that everybody knows we're not there yet. So hopefully over time, these criteria will change and become tighter. I think that's also why you see that the market standards are continuously changing. And so you look at the moment of issuance, is this acceptable? Is this in the right trajectory? And that's also why now in the sustainability linked market, we see a lot of focus also on the net zero targets, Paris aligned goals in 2050, and the trajectory towards those goals. So then at least you can say, okay, this is what's the slope where it needs to go. This is where we are right now, and you have to evidence that you are in line with that transition path. So I think that's also a way to make sure that you are going in the right direction and with the steps required.
Correct. And also, I think some of this sustainability efforts is like your golf handicap. You're actually trying to improve it all the time as you go, and you want to measure how you're going as per handicap. So I think that's part of the process of trying to improve our operations continuously.
And it is also, it's that shift from a box ticking exercise to kind of living and breathing what it's really about, isn't it? And I think you were talking to me before about really understanding your business, and Kevin's touched on it now as well. It is all integrated, isn't it? And it's not just about trying to well, it's not about greenwashing. People really are serious about this on the whole, I think, is what we're seeing anyway. But maybe standing back a little bit, could you tell us a little bit about ABN AMRO's, its focus on sustainability and what its motivation as a bank is?
Yeah, so we have of course a purpose and a strategy, and our purpose is banking for better for generations to come. Which sounds great, but then you have to translate it in something very specific. And yeah, we've said, well, we want to support our clients in the and also accelerate this sustainability shift and helping our clients in the transition. And that still sounds quite vague. So it's the issue is, how do you make it specific? Because you don't want to exclude all your clients. On the other hand, you don't want to be so easy that everything, just the business continues and it gradually changes over time. So I think that's where the challenge is, and that's also why we try to give the right example as well. So that's why we, for example, when we issued our green bond, that was the first green bond issued by a bank in Europe. And afterwards, we got a lot of questions like, how did you do it? And even today, I see other clients having the same issues, and mainly it's about data, availability of data, and sometimes about criteria. So I think that is still something we can support our clients with on a day-to-day business, but also thinking about, okay, well, what per sector are the Paris-aligned goals? Have these discussions actively with our clients, and also try to accommodate it with, for example, sustainability-linked loans, if we do it on a bilateral or together with a group of other banks. Also on the bond side, we try to be the link between the market participants, the ultimate investors, but also our own criteria. So we will ask about these trajectories, and also how the company thinks they will reach those goals. So I think that's the active approach. But of course, then we also need to make sure that we know what are the trajectories, and that's not easy. In our own case, we are currently developing our own net zero targets, but of course that's results from all the targets of our clients. So it's almost like a double exercise, and that's quite complicated. It's easy to be on a podium and say, yeah, we are aligned in 2050, but then you have to go back in the organization and make it happen. And that's why, so far we've been a bit hesitant on that side, but if we want to do it, we want to do it well. So I think that's the process we are in. But also, I think I found in the whole process with setting up the first green bond and digging up information which was not there in the organization, the moment you start looking into it and actively be busy with it, you learn so much about sustainability and what you need to do, but also what you're still missing. So you can also work on that. And I think that's a great step up for the overall business. And I think that's, perhaps also with going forward, if we see all the regulation ahead of us, I think it makes sense if you start with, for example, a piece of your financing, digging already in that part of the market. It prepares you well for all the other steps ahead of you.
Absolutely. Thanks. And just in terms of the EU taxonomy, what's your advice there for businesses, and what are the benefits they can derive, even if they haven't yet issued a green bond or been active in terms of sustainability?
Well, our advice is to start with your green bond or other green financing product. And the reason is that it's already a clearly identified portion of your activities. Probably the easier part, and you already believe it's green. So then you can also check it with the taxonomy regulation. Yeah, to be honest, not everything is already worked out completely. Of the 6 categories which the EU defined, there are only 2 are now accepted in legislation, and the other 4 are still in draft format. So we are still awaiting, for example, on circularity, we don't have the clear criteria yet. But on climate change mitigation, climate change adaptation, those criteria are there, and it helps if our clients start to look at those criteria. What are the selection criteria, or as they call it, technical screening criteria? What kind of data do you need for that to evidence that? That's already complicated in some cases, but also, and I think that's the new part of the taxonomy, is that there's also a link to the do not significant harm part. So even if you do something green, it should not cause any harm to other important elements, including the social aspect. And those criteria are in some cases pretty detailed, and that's where the issue with data comes up again. There is sometimes a reference to certain European legislation, but for example, if you are an issuer who has like a pan-European or even global activities, it's sometimes very difficult to get exactly the evidencing, because the interpretation per country might be completely different, and you might follow the rules, but it doesn't automatically show that you can evidence those do not significant harm criteria. So I think that's where most of the struggle is. It's not about the ambition of the companies most of the time, because those who are busy with it right now, they don't have to do it. So they more or less do it from a learning perspective or be proactive. And I think it's a great stepping plate to what you need to do in a couple of years' time for your entire company. So the regulation is there for the European issuers, at least, to report on the taxonomy, first on the relevance, and then later also on the alignment. but that will come pretty quickly. So it's better to start already now with a pretty well-defined portfolio before you do it for the entire firm. And exactly then you know, okay, we are missing this, this, and this. So can we work on this the next couple of years?
Absolutely. Thanks. And great advice, Jo. Just move quickly back to Kevin now to talk a little bit more about finance's role in your issuance. You know, what was the relationship with finance? How important were they? What would be your message to people working in finance?
Okay, given that I've got Lucy from A4S and Jessica, I must be definitely supporting the role of finance and sustainability. But I truly believe it. I think I myself fell into it because the regulatory bodies in Singapore required sustainability reporting back in 2017, and you know, it made me look at the whole report. I mean, the CFO is usually responsible for the annual report, so the sustainability report drops on his table, right? And it went, well, what's this all about? So I did a deep dive and became a convert, of course, and basically started to drive sustainability within my organization. Now, I look at sustainability basically as a collaboration project, actually, in a company. Because typically when you start, there's no such thing as a sustainability department, right? And I found that as I actually rolled out sustainability, you require the support of several functions within an organization. So you've got finance and accounting, because sustainability, as I said at the outset, is a cost. So you need the money guys to be on board, right? So you need to get them supportive. And then you need HR for the on-the-ground support, because I use my HR department in my various units of operations that are spread across 4 different countries, number of operations. And HR helps me collect all the environmental data that is input into an in-house database program that we've built over the years, so that we've got this data running on a regular basis, coming from all the operational units. Then you need IT to set up that database system. You need IR, PR, you need corporate finance in terms of funding opportunities. But most of all, you need buy-in from operational management. As I said before, if you didn't have operational management buy-in, I wouldn't have been able to actually launch my bond. So why is CFO important, or the finance person important? I think CFO provides access to senior management. We can actually arrange a meeting with senior management and get them to come to a buy-in session where we can explain that while it might look like these sustainability initiatives have a broad function of saving the world, but essentially there are granular reasons and hopefully short-term real tangible benefits that we can deliver in our business that makes it very real for people to actually bring it on board. And for me, I think that's where the CFO sits as an important function, and also the whole finance function. So yeah, I'm definitely a supporter of accounting for sustainability, for sure.
Great, thanks, Kevin. And just before we move on to a poll to get our audience involved again, yeah, would you like to add anything about the importance of finance to the whole process within bond issuances?
Yeah, I think the finance department is also, I think, an important part of the link between the company and the outside world, being either the investors or the banking group. I think that's important, especially since investors are driving so much of these changes. I think it's good to keep an eye and an ear in the market, what's going on, and it's the same for the banking group, or if you do bilateral loans, counterparties. So I think then you clearly see that it's not only a nice marketing gimmick, it's something real, that there's real demand behind it. And I think that's something you can translate internally, and that's what I've seen as well in our company. When we started to talk about commercial real estate, for example, we said the department itself was already developing new targets, and then they said, well, if we do this, we might as well link it to what the market expects, because in the future, in the long run, that's probably a better way of doing it. So then we more or less took those green bond targets and introduced it also internally. And so these kind of cooperation, I think, exist if you are active in this way, and I think that's quite helpful and makes your organization more future-proof, I believe.
Indeed, and that collaboration is absolutely essential, and we see more and more of it through these kinds of programs, which is great. Going to move on to a little poll now. I hope somebody in the background is going to help me on this one. So the first question is going to be, which of these drivers, you can be shown a selection, there we are, which of these drivers are most likely to influence your decision to consider sustainability-linked bonds? And as you're reading through them, I'll just look myself, responding to growing market recognition, tying into KPIs, enhancing your company's sustainability credentials, facilitating greater market access, attracting investors who take a long-term view and support ambitious targets with science-based criteria. My panelists, they may have some thoughts on this too, when we, as we're not allowed to vote. So just giving you a moment or two to complete that poll. It should maybe be an all of the above. Okay, so it looks like the slightly most popular one is tying into KPIs that are relevant and material to my company, etc., etc. But very closely behind that is responding to growing market recognition, and then very closely behind that is enhancing my company's sustainability credentials. So all good stuff. Any comments from our panelists on what you think are the most important elements, or are they all important? Maybe start with you, Joop, before we move to Kevin.
Yeah, it's difficult to make a choice. I indeed, they need to be, the targets need to be relevant and material. I think that's more or less the base requirement, and that's part of the long-term ambition. I think one of the elements I've also seen is in the past, when we started green bonds more on the asset-based focus, there were some issuers were, let's say, left behind because they were not so capex heavy and more focused on operational expenditures. And then obviously it's quite difficult to find enough projects to fill a 300 or 500 million bond. And the sustainability linked bond market was a very good solution, because you can still talk about your targets and everything you do internally. So maybe that's also part of the greater market access. So that's definitely something I also think is a good benefit.
Thanks, Joop. Kevin, any thoughts?
Yeah, very good point, Joop, because basically as a poultry company, there's no chance I'll have a green bond, because as you say, the minimum issue size is $350 million US, right? And I don't have a single chicken farm that's that big. So really all I can do in my sustainability efforts is to link in some real relevant material target, to my particular life cycle for my product. In essence, chickens are not that bad to the environment anyway. So really my focus is try and do better and trying to improve ourselves, so that in the long run, we have a product and we have a business that's going to last for a while. So really, I think it's all of the above, Carolyn. Agree with you.
Yep, agree.
And you point on top of that.
Well, we've got a final quick poll, if we could post that one up. This one is, what are the potential benefits of integrating environmental and social factors into debt financing, having a sustainable finance framework? Select all that apply. We've got some interesting things: greater access to capital, enhanced ESG credentials, higher credit rating, better risk management due to more accurate valuation of environmental and social impacts and dependencies, and improved dialogue with debt providers and ESG rating agencies. So You can select all that apply, and we'll give you a moment or two to complete that. I think completing is part of your CPD here today, so do complete that poll, and I'll leave my A4S colleagues to let me know when we've got some results we can post up, please. You're looking good. Right, well, we've got slight variations, you know, a lot of very popular, and the improved dialogue with debt providers clearly is everyone is on for that one. Higher credit rating is a bit lower. Some people don't have credit ratings, so maybe it's not even relevant, but it looks like all of those are pretty important. So thank you very much for providing that information. Just before we move over, I know that we need to leave some time for Jessica to come in with a few final points that she has on the agenda for today. But I'd just like to, and if there's no further questions from the audience, I'd like to turn to both you and Kevin to ask them about, you know, what have been the key learnings for them in terms of sustainable finance over the last period, and any particular message they have got for the audience. And so, Kevin, can I start with you, please?
Okay, my message would be to prepare your organization, and hopefully that's through a life cycle assessment, so you can actually have some data. And it's a long process if you do it formally like we did. And that process leads to actually a system where you need to implement a data collection system as well. And I'm only a part of the journey, of the sustainability journey. So with A4S now, we're working to take the next steps. For example, setting targets to put in our CAPEX planning every year, in our CAPEX assessment and considerations, we are adding a sustainability element. So the operational units have to actually identify whether this project is sustainable, what are the sustainable features, et cetera, within the project, basically making people think about sustainability at the operational level. I think the longer term objectives would be to then develop KPIs in the operations alongside with management KPIs that have a sustainability linkage. And I think all this is a journey, and I would say the start of the journey starts with a formal assessment of your business, a measurement and a quantification of the various environmental issues in your business. And then from there, you can start making improvements and hopefully develop a system to embed sustainability in the day-to-day operations of everybody's work. So, yeah.
Thanks, Kevin. And your quick thoughts from your side?
Yeah, I think, well, Kevin, I think already explained it well. I think the key thing is to just start doing it. I think that's the best way of going forward and learn more about what you exactly need data-wise. You get questions from the second opinion providers, you get questions from investors. So you'll have to return back into the organization and say, hey, listen, what we heard, this is also something we have to take into consideration. So I think those feedback loops are so important in also developing your own internal organization even better. And I think it also prepares you extremely well for everything which is now ahead of you from all the formal reporting part. But the key thing is if you have to know your business, but yeah, especially financial institutions and probably many corporates as well, they have a lot of data on the financial side, but not so much on the those elements which are required for the ESG part. So I think that is what needs to change. And I think to start with sustainable finance, I think is a good road in, which you have to do at a certain point in time in any case. So
thanks, Yep.
Yeah, like Nike said, just do it.
Indeed. Now we have a question from the audience, which is absolutely fascinating. So I'm going to just give my panelists like 2 seconds really to answer this question, because we do have to hand over to you, but it's such a good one. So this is a question. To Caroline's point that the ACT are no longer going to have a separate category for the Deal of the Year awards, with increasing regulation in this area, how long do you think it will be before there is no green sustainability linked debt, and companies that cannot link their debt to an ESG program will have to pay a premium? Any quick response from Kevin or Joop, or both? How long?
Well, I think it's also what I hope at least is that there will be both a carrot and a stick. I think that would make our life much easier, and also probably easier to convince Kevin's board to do more of these transactions. I think nobody is worried if you pay something, if there would be a benefit. I think that would also be yeah, an important move. I think so. Yeah, I think that would be. On the other hand, I think if you have only targets with no, and you might have a pricing benefit already, then it also makes sense that there is some kind of a premium if you fail to adjust. But it's a bit of a tricky part, because some investors also say, yeah, we would like to see something that the outcome is indeed what is promised. So now we are getting paid if it doesn't work out. So that's maybe just a little bit the other way around as we would like to see it. But yeah, on the other hand, the market is also not that ready to accept like discounts, especially if the level of knowledge about the company is maybe not as equal from an investor point of view.
Indeed. Thanks very much.
Actually, you took the words out of my mouth. Carrot rather than a stick. So I've seen some carrots from our bankers, though. So that's the good news. So in terms of sustainability linked loans, using the similar sustainability framework that we use for our bonds, we are seeing more and more banks at least step up to saying that these are the things you need to do in terms of performance targets, and we will reward you. So I think that's a much better structure rather than a penalty, and it would inspire, I think, more companies to aspire to actually write some of those loans.
Well, thank you both so much. I'm sorry we haven't got more time. We could go on for a lot longer, but we get in real trouble if we did that. Thanks for joining us from around the world. And I just noticed on that point that myself and Kevin, we've got the Dutch orange, and you in the background, you've got the red, white, and blue, and that's really important for us over here in the UK because it's the Queen's celebrations later this week. So yeah, what a nice global community we are. But with that, thank you once again, both of you. Been really, really interesting. And over to Jessica.
Thank you, Caroline. So I'm just going to give a brief introduction to the A4S resources for our audience. So I'm sure many of you are inspired by what you've heard today and want to get started or further develop your work on embedding environmental and social considerations into your financial decisions. So we have the A4S Essential Guide to Debt Finance, which includes an introduction on why considering sustainability is important for treasurers and perspectives from both debt providers and issuers based on interviews that we've conducted with them. It also has guidance and tips for integrating sustainability into Treasury team activities and for engaging with your debt providers on sustainability factors, including case studies and practical examples like what we've heard today. It's created by Treasury teams and for Treasury teams, but it will be of interest as well to debt investors and lenders also. The other resource that we have for Treasury teams is our top tips on implementing a sustainable finance framework. And it was developed based on the experience and insights from members of the A4S CFO Leadership Network, who have been putting into place sustainable finance frameworks and issuing sustainability related financial instruments in the markets, such as sustainability or green bonds, like we've also heard about today. So it's a really good starting point for treasurers who are beginning to consider sustainable finance, and companies who are sustainability might not yet be fully embedded into their decision making and into the business strategy. So Treasury teams can start with a framework that supports the financing of planned projects through the issuance of green, social or sustainability bonds, and adopt the use of proceeds approach, and then gradually build from there. And implementing a sustainable finance framework is an important first step to access the sustainable finance market and take advantage of market interest and opportunities, as we've been made aware of. So the Top Tips Guide explains the key benefits of having such a framework, which includes helping Treasury teams to make more informed financing decisions, better manage the associated risks, initiate dialogue with market participants on ESG, and maintain access to capital and potentially lower cost of capital. Ultimately, as we know, Treasury teams can play a strategic role in steering their company towards a more resilient business model and achieving its sustainability goals. So both resources will be sent to you in a follow-up email after the webinar. Today, Caroline has shared some excellent insights, and Kevin and you gave us great practical examples on implementing sustainability-linked financing and what it can look like, and the latest developments and trends in the sustainable finance market. So we would like to run a call for action poll. How will you translate everything that you have learned in this webinar to your work in the next 6 months? So really this is a trigger to get started on what you're doing. So start incorporating those ESG risks, have a dialogue with debt providers, form internal working groups, develop a sustainable financing framework, engage with the CFO, or just engage with the A4S resources more broadly. Okay, so most people are going to be engaging with the A4S resources, so please do look out for that follow-up email. These webinars are held monthly and explore a different topic each month. So in June, we have 2 webinars, one on natural capital on the 14th of June and another one following on net zero as well. So the registration links to these webinars will be in the follow-up email. If you are interested in these webinars and unable to join live, please remember that you can record these sessions and we make them available as on-demand webinars on our website. So you can rewatch this one if you want, or watch any of the others that we've already done. And we're keen to get your feedback. So we're going to run one final poll for you to complete as we draw to a close. So please let us know how you've experienced today's webinar on debt finance. And again, I just really want to thank our panelists and Caroline today. It's been a really useful and insightful discussion. And I think we can all agree that it's been a fantastic opportunity to learn more about debt finance. So thank you very much, everybody. And I hope everybody has a good day.